take a moment to welcome our featured guest to the program. He's a familiar face, Jeff Hull, Senior Financial Advisor at Manulife Wealth. Jeff, thanks a lot for being here.
My pleasure.
Now let's go to Ken Wong. He's Managing Director of Software Research at Oppenheimer, and he joins us from San Francisco. Ken, unpack these results for us. And are investors correctly alarmed at the gross margin guidance?
Hey, good morning, Paul. Thanks for having me on. I think it's less the gross margins. This is definitely one of those situations where Shopify is a victim of high investor expectations. Premium valuation multiple at 11 times 24 revenue. They had fairly razor thin margin for error going into the print. We had previewed that investors were looking for growth closer to mid 20%. And as you mentioned, they grew 23%. So a shade shy of that. The source of that relative shortfall was from GMV, where I think growth was expected to be closer to again, mid 20s, maybe a little bit above. But otherwise, I think profitability-wise, the company did hit on the mark, and guidance we thought was good enough.
Tell us more about the guidance being, quote, good enough.
Yeah, I think on guidance, everyone knew that coming into this year, it would be a little light versus 23, just because they divested their fulfillment business. And going into the print, knowing that revenue would be at least low 20s, probably mid 20s, the expectations were that they would probably guide to something around high teens, which is what we got from management today. From a spend perspective, I would say right in line. Arguably, you could argue that it's a shade high, growing sequentially low single digits to mid single digits. I think investors were tracking closer to low single digits after a big uptick in spend in Q1. But again, I think we might be splitting hairs here at this point. Overall, I thought the guidance was probably, again, good enough, arguably a little better than we were thinking going into the print.
Ken, question for you. How important is the international markets for Shopify moving forward?
Look, very, very important. They've largely exhausted their base of small, mid-sized merchants in the U.S., partly why they are pushing up market to enterprise. International remains a very ripe source of growth for them to hopefully replicate what we saw in the U.S., where they, quote unquote, arm the rebels and help drive large tech down to smaller mom and pop merchants.
The company says to investors, you're seeing the strongest version of Shopify in our history. Do you agree? Is the company financially stronger now than it has been up until now?
Definitively. I mean, we don't quite have the COVID-like peak growth rates, but I think from an overall kind of balanced growth perspective, we're still seeing north of 20% growth, which is pretty difficult to find in software these days, while also delivering on really strong profitability. They delivered 12% free cash flow margins this quarter. We're assuming that number trends closer to the high teens as we exit the year, and likely kind of positions these guys to be closer to that enterprise SaaS long-term margin profile of mid-20s. So, from a balanced growth perspective, I definitely do agree that this is probably the best version of Shopify.
In a note in which you previewed these results, you focused in a couple of different ways on higher operating expenses. Talk to us about that.
Yeah, well, in Q1, management going into Q1, management surprised investors a little bit with OpEx that spiked about low double digits. They still tracked below that, growing OpEx by our accounts, high single digits. I think that was just one area of investment where after 3 straight quarters of cutting, they reduced headcount pretty significantly in 2023. They exited their fulfillment business. Going into the print, that probably caught people a little bit off guard. But as we noted, at least for Q1, at least for how they've guided for second quarter, the OpEx run rate does seem a little lower than how people were thinking probably 3 months ago. I think this is just staying in line with management's best efforts to, properly grow the business while showing some restraint on the spend side.
Ken, if there was an actual fly in the ointment moving forward, an Achilles heel somewhere in Shopify's business that could worry you a little bit, what could that be?
We had published a piece earlier in March where, again, we had highlighted that investor expectations probably got a little carried away, specifically in regard to growth in the back half. We were coming off of very tough growth comps, driven largely by price increases that management put through in early 2023. So as we start to lap some of that uplift, we do worry that growth could tick a shade below 20%, could hover closer to the mid-high teens. Again, more a dynamic that is less, fundamental specific, but just from the optics of what investors are looking for when paying a premium for software companies. Again, 20% is arguably the new hyper growth, and that's what's justifying the double-digit EV to sales multiples.
Do you have a rating and a price target on the shares?
Yeah, we are outperformed with an $80 price target. So shares were approaching our price target. So this pullback, we do expect that, assuming kind of core fundamentals remain intact and we still remain, positive on the longer term trajectory, we think that $80 is a pretty good benchmark.